Question 1. General insurance concepts. Underwriting and policy issuance. An insurance company is considering issuing homeowners policy to client who lives in high-risk flood zone. Which of the following actions would be considered an appropriate underwriting decision under Kansas insurance regulations? A. Decline the application because the property is in high-risk flood zone even if the client agrees to higher premiums. B. Approve the policy with standard premium rate and no exclusions for flood damage. C. Approve the policy but exclude flood damage coverage and offer the client the option to purchase flood insurance separately through the National Flood Insurance Program (NFIP). D. Approve the policy but impose mandatory deductible of 50% of the policy's coverage limit for any water-related damage. Answer. C. Explanation. Under Kansas law and federal guidelines, flood insurance must be obtained through the National Flood Insurance Program (NFIP) for properties in high-risk flood zones. Private insurers typically do not cover flood damage under standard homeowner policies. The correct approach is to approve the policy while excluding flood damage and direct the client to purchase separate coverage through the NFIP. Option is incorrect because declining the application solely based on the high-risk flood zone may be considered discriminatory. Option B is incorrect because offering full coverage for flood damage under a standard policy would violate standard underwriting practices. Option D is incorrect because imposing an excessively high deductible would likely be considered unfair and could violate Kansas's Unfair Trade Practices Act. Question 2. Scenario-based Kansas Insurance Department structure and responsibilities. Emily Thompson is a newly licensed insurance producer in Kansas. She recently moved to a new office and has updated her contact details. However, she is unsure if she needs to notify the Kansas Insurance Department about this change. Additionally, she plans to start selling annuities and is wondering if there are any additional requirements she must fulfill to do so. What actions should Emily take to remain compliant with Kansas insurance regulations? A. Notify the Kansas Insurance Department within 60 days of her address change and complete a one-time annuity training course before selling annuities. B. Notify the Kansas Insurance Department within 30 days of her address change and complete a 4-hour annuity training course before selling annuities. C. Notify the Kansas Insurance Department within 15 days of her address change and complete a 6-hour annuity training course before selling annuities. D. Notify the Kansas Insurance Department within 45 days of her address change and complete a 2-hour annuity training course before selling annuities. Answer. B. Explanation. According to Kansas insurance regulations, producers must notify the Kansas Insurance Department within 30 days of any changes to their address. To sell annuities, producers must complete a 4-hour training course on annuities as required by the Kansas Annuity Suitability Act. Option is incorrect because the notification period is 30 days, not 60 days. Option C is incorrect because the required annuity training is 4 hours, not 6 hours. Option D is incorrect because the notification period is 30 days, not 45 days, and the training requirement is 4 hours, not 2 hours. Question 3. Unfair Trade Practices Act. Rebating. Which of the following scenarios would be considered violation of Kansas's Unfair Trade Practices Act related to rebating? A. An insurance agent offers $50 gift card to prospective client in exchange for purchasing life insurance policy. B. An insurance agent provides client with list of policy benefits to help the client make an informed decision. C. An insurance agent offers discount on premiums to long-time client as gesture of appreciation for loyalty. D. An insurance agent sends holiday greeting card to all their clients without any financial incentive. Answer A. Explanation. Rebating is the illegal act of offering a client a financial incentive to purchase an insurance policy, such as cash, gifts, or discounts not included in the policy itself. Kansas law strictly prohibits rebating to ensure fair competition and protect consumers from being influenced by improper incentives. Option is a clear case of rebating and is prohibited under Kansas's Unfair Trade Practices Act. Option B is not rebating. Providing policy information is part of the agent's fiduciary duty. Option C is incorrect because offering discounts on premiums outside of approved rate filings is illegal. Option D is not rebating, as sending greeting cards does not constitute financial incentive. Relevant law KSA 4024048 outlines the prohibition of rebating in Kansas. Question 4. Kansas no-fault insurance. Personal injury protection (PIP) in Kansas. Which of the following statements about personal injury protection (PIP) coverage is accurate? A. Pet coverage is optional for all drivers in Kansas. B. Pet coverage must include compensation for lost wages, medical expenses, and funeral expenses. C. Pet coverage only applies if the insured is at fault in an accident. D. Pet coverage excludes payment for rehabilitation services after an accident. Answer: B. Explanation: Kansas is a no-fault insurance state, meaning PIP coverage is mandatory for all drivers. PIP provides benefits regardless of who is at fault in an accident. Kansas law mandates that PIP policies include medical expenses, lost wages, rehabilitation services, and funeral expenses. Option is incorrect because PIP is required by law in Kansas. Option C is incorrect because PIP applies regardless of fault. Option D is incorrect because PIP does cover rehabilitation services. Relevant law KSA 403107 outlines the mandatory PIP coverage requirements in Kansas. Question 5. Scenario-based disciplinary actions and penalties. Michael Reed, an insurance producer in Kansas, has been accused of twisting, convincing client to switch policies by making misleading comparisons between the new policy and the existing one. The client filed complaint with the Kansas Insurance Department. What disciplinary action can the Kansas Commissioner of Insurance take if Michael is found guilty of twisting? A. Issue warning and impose $1,000 fine. B. Revoke Michael's license and impose $500 fine. C. Suspend Michael's license and impose fine of up to $5,000 per violation. D. Require Michael to retake the state licensing exam and issue written apology to the client. Answer: C. Explanation. Twisting is a violation of the Kansas Unfair Trade Practices Act. The Kansas Commissioner of Insurance can impose license suspension or revocation and fines of up to $5,000 per violation for such unethical behavior. Option is incorrect because a warning and $1,000 fine would not be severe enough for twisting. Option B is incorrect because while the license can be revoked, the fine amount is incorrect. Option D is incorrect as there is no regulatory requirement to retake the exam or issue apologies. Relevant law KSA 402404 prohibits twisting and outlines the penalties for violations. Question 6. Auto insurance requirements in Kansas. Which of the following coverages is not required by Kansas law for a personal auto policy? A. Personal injury protection PIP. B. Liability coverage. C. Uninsured motorist coverage. D. Collision coverage. Answer: D. Explanation. Kansas law requires PIP, liability coverage, and uninsured motorist coverage, but collision coverage is optional. Collision coverage pays for damage to your own vehicle after an accident, but it is not mandated by law. Option is incorrect because PIP is required. Option B is incorrect because liability coverage is required. Option C is incorrect because uninsured motorist coverage is required. Option D is correct because collision coverage is optional. Relevant law KSA 403107 outlines the minimum insurance requirements in Kansas. Question 7. Life insurance. Annuities and retirement products. Which of the following statements regarding fixed annuities is true under Kansas law? A. Fixed annuities guarantee minimum interest rate but offer no protection from inflation. B. Fixed annuities do not guarantee principal protection and are subject to market risk. C. Fixed annuities are regulated by the Securities and Exchange Commission (SEC). D. Fixed annuities require the annuitant to pay taxes on earnings before withdrawals are made. Answer: A. Explanation. A fixed annuity provides a guaranteed minimum interest rate and principal protection, but it does not protect against inflation. Fixed annuities are regulated as insurance products, not securities. Option B is incorrect because fixed annuities guarantee principal protection. Option C is incorrect because fixed annuities are regulated by state insurance departments, not the SEC. Option D is incorrect because earnings in a fixed annuity grow on a tax-deferred basis. Relevant law: Kansas Insurance Code governs annuities and retirement products. Question 8. Ethical practices. Fiduciary responsibilities. An insurance producer in Kansas must act in fiduciary capacity when handling client funds. What does this mean? A. The producer must invest client funds to achieve maximum returns. B. The producer must hold client funds in separate account and use them only for their intended purpose. C. The producer can use client funds to cover personal expenses as long as they reimburse the account within 30 days. D. The producer can deposit client funds in general business account for easier management. Answer: B. Explanation. A fiduciary responsibility requires the producer to hold client funds in a separate account and use them only for their intended purpose. Misusing client funds is a violation of Kansas law and can result in disciplinary actions. Option is incorrect because producers should not invest client funds. Option C is incorrect because using client funds for personal expenses is illegal. Option D is incorrect because client funds must be kept in a trust account, not a general business account. Relevant law. KS State 40247 governs fiduciary responsibilities in Kansas. Question 9. Property insurance. Business interruption coverage. Which of the following is covered under typical business interruption insurance policy in Kansas? A. Loss of future market share due to competitors' new product launch. B. Lost revenue due to covered peril such as fire or storm. C. Costs associated with recalling defective products. D. Losses incurred from cyber attack. Answer B. Explanation. Business interruption insurance covers lost revenue due to a covered peril such as fire or storm that forces the business to suspend operations temporarily. Option A is incorrect because business interruption coverage does not cover market share loss. Option C is incorrect because product recalls are not covered. Option D is incorrect because cyber attacks require cyber liability insurance, not business interruption coverage. Relevant law. Kansas follows standard property insurance guidelines for business interruption coverage. Question 10. Workers' compensation insurance. Kansas requirements in Kansas. Which of the following employers is exempt from providing workers' compensation insurance? A. An employer with 5 or fewer agricultural workers. B. Construction company with 15 employees. C. Manufacturing firm with 3 employees. D. An employer in non-agricultural industry with 8 employees. Answer A. Explanation. Kansas law exempts agricultural employers with 5 or fewer workers from mandatory workers' compensation coverage. However, most other employers are required to provide workers' compensation. Option B is incorrect because construction companies must provide coverage regardless of size. Option C is incorrect because manufacturing firms are required to provide coverage. Option D is incorrect because non-agricultural employers with more than 4 employees must provide coverage. Relevant law. KS 44505 outlines workers' compensation exemptions in Kansas. Question 11. Kansas auto insurance. Financial responsibility law. Under Kansas law, what is the minimum liability coverage required for bodily injury per person in an auto accident? A. $15,000. B. $25,000. C. $50,000. D. $100,000. Answer B. Explanation. Kansas law requires a minimum liability coverage of $25,000 for bodily injury per person in an auto accident. The minimum for bodily injury per accident is $50,000, and for property damage it is $25,000. Question 12. Scenario-based claims handling. Timely payments. Kansas insurance company receives claim for property damage from policyholder. The insurer conducts an investigation and agrees to pay the claim. How many days does the insurer have to issue payment after agreeing to settle the claim? A. 10 days. B. 15 days. C. 30 days. D. 45 days. Answer C. Explanation. Under Kansas law, an insurer must issue payment within 30 days after agreeing to settle a claim. Failing to do so can result in penalties for unfair claims practices. Question 13. Kansas Insurance Commissioner. Powers and duties. Which of the following is not power of the Kansas Insurance Commissioner? A. Investigating complaints against insurers and producers. B. Issuing cease and desist orders. C. Establishing insurance premium rates. D. Imposing fines for violations of insurance laws. Answer C. Explanation. The Kansas Insurance Commissioner does not set insurance premium rates. Premium rates are determined by insurers but must be filed with and approved by the Kansas Insurance Department. Question 14. Homeowners insurance. Dwelling coverage. Which of the following perils is excluded from coverage under standard Kansas homeowners insurance policy? A. Fire. B. Hail. C. Earthquake. D. Theft. Answer C. Explanation. A standard Kansas homeowners policy does not cover earthquake damage. To be protected against earthquakes, homeowners must purchase a separate earthquake endorsement. Question 15. Kansas workers' compensation. Employer responsibilities in Kansas. Which of the following injuries is not covered under workers' compensation policy? A. An injury that occurs during lunch break off-site. B. An injury that occurs while using faulty equipment provided by the employer. C. An injury that occurs while driving company vehicle for work purposes. D. An injury that occurs during scheduled meeting on company property. Answer A. Explanation. Workers' compensation in Kansas does not cover injuries that occur during off-site personnel activities such as lunch breaks unless the employer requires the activity or location. Question 16. Scenario-based uninsured under insured motorist coverage. Emily is driving her car in Kansas when she is hit by another driver who has no insurance. Emily suffers injuries and incurs medical expenses of $40,000. Her own auto policy includes uninsured motorist coverage with a limit of $50,000 per person. How much will Emily's uninsured motorist coverage pay for her medical expenses? A. $10,000. B. $20,000. C. $40,000. D. $50,000. Answer C. Explanation. Since the at-fault driver has no insurance, Emily's uninsured motorist coverage will cover her medical expenses up to her policy limit. In this case, it will pay $40,000 to cover her expenses. Question 17. Kansas Insurance Producer License. Continuing education requirements. How many hours of continuing education C are required for Kansas Insurance Producer to renew their license? A. 12 hours every 2 years. B. 24 hours every 2 years. C. 30 hours every 3 years. D. 36 hours every 4 years. Answer B. Explanation. Kansas requires 24 hours of continuing education C every 2 years to maintain an active insurance producer license. Of these, at least 3 hours must focus on ethics. Question 18. Commercial property insurance. Vacancy clause. Commercial property policy in Kansas contains vacancy clause. If building has been vacant for more than 60 days, what happens to the policy coverage? A. Coverage remains the same. B. Coverage is reduced by 50%. C. Certain perils are excluded from coverage. D. The policy is automatically cancelled. Answer C. Explanation. If a commercial property is vacant for more than 60 days, certain perils, such as vandalism, theft, and water damage, are excluded from coverage under the vacancy clause. Question 19. Ethical practices. Rebitting. Which of the following actions is considered rebitting under Kansas insurance laws? A. Offering client small gift as thank you for their business. B. Offering client discount on their premium in exchange for purchasing another policy. C. Providing client with copy of the insurance policy free of charge. D. Offering client additional coverage at no extra cost. Answer B. Explanation. Rebitting involves offering unauthorized discounts or incentives to clients to encourage them to purchase an insurance policy. This practice is illegal in Kansas. Question 20. Flood insurance. National Flood Insurance Program (NFIP). Which of the following statements about flood insurance in Kansas is correct? A. Flood insurance is automatically included in standard homeowners policies. B. Flood insurance is only available through private insurers. C. Flood insurance is required for all Kansas homeowners. D. Flood insurance is available through the National Flood Insurance Program (NFIP). Answer D. Explanation. Flood insurance is not included in standard homeowners policies and must be purchased separately. In Kansas, it is available through the National Flood Insurance Program (NFIP), a federal program. Question 21. Kansas property insurance. Cancellation and non-renewal under Kansas law. How many days' notice must an insurer provide to policyholder when cancelling homeowners policy for non-payment of premium? A. 10 days. B. 15 days. C. 30 days. D. 45 days. Answer A. Explanation. Kansas law requires insurers to provide at least 10 days' notice when cancelling a homeowner's policy due to non-payment of premium. Question 22. Scenario-based commercial general liability. Aggregate limits. Kansas business owner has commercial general liability (CGL) policy with an aggregate limit of $1 million. The business has already paid out $800,000 in claims during the policy period. New claim for $300,000 is filed. How much will the policy pay for the new claim? A. $0. B. $200,000. C. $300,000. D. $1 million. Answer B. Explanation. The aggregate limit is the maximum amount the insurer will pay during the policy period. Since the business has already used $800,000 of its $1 million aggregate limit, the policy will only cover $200,000 of the new claim. Question 23. Kansas Fair Plan. The Kansas Fair Plan provides insurance coverage for which of the following? A. High-risk drivers. B. Uninsurable commercial properties. C. Homeowners who are unable to obtain coverage through the voluntary market. D. Agricultural equipment. Answer. C. Explanation. The Kansas Fair Plan Fair Access to Insurance Requirements is designed to provide property insurance to homeowners and businesses that cannot obtain coverage through the voluntary market due to high-risk factors. Question 24. Kansas Workers' Compensation. Eligibility. Which of the following employees is exempt from Kansas Workers' Compensation coverage? A. Part-time retail worker. B. Farm worker employed by large agricultural business. C. Corporate executive. D. An independent contractor. Answer. D. Explanation. In Kansas, independent contractors are generally not covered under workers' compensation laws. However, employers are required to provide coverage for most employees, including part-time and seasonal workers. Question 25. Scenario-based personal auto policy. Collision coverage. Mark has personal auto policy in Kansas that includes collision coverage. While driving on an icy road, Mark loses control of his vehicle and hits tree, causing $6,000 in damage. His collision coverage has $500 deductible. How much will the insurer pay for the damages? A. $5,000. B. $5,500. C. $6,000. D. $6,500. Answer. B. Explanation. The insurer will pay $6,000 minus the $500 deductible, resulting in a payment of $5,500. Question 26. Kansas Insurance Guarantee Association. What is the maximum amount that the Kansas Insurance Guarantee Association will pay for a covered claim if an insurer becomes insolvent? A. $100,000. B. $250,000. C. $300,000. D. $500,000. Answer. C. Explanation. The Kansas Insurance Guarantee Association will pay up to $300,000 for a covered claim in the event that an insurer becomes insolvent. Question 27. Kansas No-Fault Auto Insurance. PIP benefits under Kansas no-fault insurance laws. Which of the following expenses is not covered by personal injury protection? PIP benefits. A. Medical expenses. B. Lost wages. C. Pain and suffering. D. Rehabilitation costs. Answer. C. Explanation. Personal injury protection. PIP benefits in Kansas cover medical expenses, lost wages, and rehabilitation costs, but they do not cover pain and suffering. Pain and suffering can only be claimed in cases involving serious injury. Question 28. Scenario-based unfair claims practices. A Kansas insurer delays the payment of a legitimate claim for 90 days without providing a valid reason. The policyholder files a complaint with the Kansas Insurance Department. Which unfair claims practice is the insurer likely guilty of? A. Misrepresentation of policy terms. B. Failing to affirm or deny coverage within a reasonable time. C. Offering settlements below policy limits. D. Cancelling a policy without proper notice. Answer. B. Explanation. Delaying the payment of a legitimate claim without a valid reason is considered failing to affirm or deny coverage within a reasonable time, which is a violation of Kansas insurance regulations. Question 29. Kansas insurance regulation. Unauthorized insurers. Which of the following actions is not permissible under Kansas insurance regulations regarding unauthorized insurers? A. An unauthorized insurer can offer insurance to Kansas resident if the insurance is procured through surplus lines broker. B. Kansas resident can purchase insurance from an unauthorized insurer if the policy is issued through licensed agent. C. An unauthorized insurer can write insurance policies for Kansas residents only if the insurer is admitted in the state. D. An unauthorized insurer can face penalties for engaging in business within Kansas without being properly licensed. Answer. B. Explanation. Kansas law prohibits purchasing insurance from an unauthorized insurer unless it is procured through a licensed surplus lines broker. Insurance purchased directly through an unlicensed insurer, even if through a licensed agent, is not permissible. Unauthorized insurers must comply with the state surplus lines laws for legal operation. Question 30. Kansas insurance licensing. Temporary license in Kansas. Temporary insurance license can be issued to which of the following individuals? A new insurance producer who has not yet passed the licensing exam. B. The spouse of deceased insurance producer. C. Policyholder who files claim. D. An insurance company executive. Answer B. Explanation. Kansas may issue a temporary insurance license to the spouse or legal representative of a deceased or disabled insurance producer to allow them time to manage or close the insurance business.